There are 4 general methods for valuation of flows and positions. Nominal value is the amount the debtor owes to the creditor, which comprises the outstanding principal amount, including any accrued interest. The nominal value reflects the value of debt at creation, which are the funds originally advanced, plus any subsequent new disbursements, plus any interest accrued, minus any repayments of principal and accrued interest, plus or minus valuation changes, which are exchange rate and price changes and other changes in volume. The nominal value of a debt instrument is a measure of value from the viewpoint of the debtor, because at any moment in time, it is the amount that the debtor owes to the creditor. Interest accrued but not yet paid is one of the factors that determines the nominal value of a debt instrument. It does not matter whether this interest is from a discount or a premium and/or from a coupon. Nominal value in domestic currency of a debt instrument denominated in foreign currency also includes changes arising from exchange rate variations. The market value is defined as the amount of money that willing buyers pay to acquire something from willing sellers. The exchanges are made between independent parties and on the basis of commercial considerations only, sometimes called at arm's length. Market prices for the positions of financial assets and liabilities should, in general, be valued as if they were acquired in market transactions on the balance sheet reporting date, the so-called reference date. The market value of a debt security should be determined by its market price prevailing on the reference date to which the position relates. Fair value is the amount for which an asset could be exchanged or a liability settled between knowledgeable, willing parties in an arm's-length transaction. The fair value of a debt instrument is its market equivalent value. It is needed to value assets and liabilities that are not traded in financial markets or that are traded infrequently. Fair value represents an estimate of what could be obtained if the creditor had sold the financial claim. Face value or par value is the undiscounted amount of principal to be paid to the holder at maturity. The face value of a debt instrument has been used to define nominal value in some instances, since the face value is the undiscounted amount of principal to be repaid. The use of face value as nominal value in measuring the gross external debt position can result in an inconsistent approach across all instruments and is not recommended. For instance, the face value of deep discount bonds and zero coupon bonds includes interest costs that have not yet accrued, which is counter to the accrual principle. Before maturity, the market value of a bond may be greater or less than the face value, depending on the interest rate payable and the perceived risk of default. As bonds approach maturity, market value approaches face value. Let's look at an example of the valuation of a zero-coupon bond. A government issues a zero-coupon bond with a face value of 100 at a price of 80. At the time of the bond issue, the face value is 100, and it remains 100 for the entire life of the bond. However, at the time of the bond issue, the nominal and market values are 80. Immediately after the bond issue, the nominal value of the bond increases as interest accrues. The market value of the bond fluctuates according to the prevailing market interest rates. At maturity, the market, nominal, and face value of the bond are the same, 100.